All right, so let's look at an installment note that has a monthly payment. On January 1st, 2021, Corvallis Carnivals borrows $30,000 to purchase a delivery truck by agreeing to a 5% 5-year loan with the bank. Payments of 566.14 are due at the end of each month, with the first installment due on January 31st, 2021, which is 1 month later. Almost. Most of the time the payments are due on the first day of the next month, but this problem's a little different. Complete the amortization schedule for this loan. So when we do an amortization schedule, first thing we need is the carry value. Now remember, carry value is the amount we owe, the amount we would show on the balance sheet, and for this loan it's $30,000. Now notice it doesn't tell us to round to the whole dollar in computation, so we're going to carry this one out to the penny. Monthly payments work better if you carry them out to the penny instead of trying to round them. We would have a mess if we rounded. All right, so on January 31st, we'll make our first payment of $566.14. Well, that's the amount of cash we're going to pay every single month, just like you would if this were a car loan or whatever. Now, how do we calculate interest? Well, interest is principal times rate times time. Principal is the amount we owe. In other words, the carry value on the note. On an installment note, that carry value is going to change with each payment. So let's start here. Do our first month's interest. We would take $30,000. Multiply that by our 5%. Now, how much time has passed? Well, we only need to accrue 1 month worth of interest. But remember, interest rates are expressed in annual terms. So we only need to accrue 1 month of that interest out of 12. So we're going to take that 30,000, multiply that by 5%, multiply it by 1, divided by 12, and that gives us $125 in interest for our first payment. Now, we paid $566.14. 125 of it is going to pay interest. So that means when we make this payment, we're going to reduce the debt we owe by $441.13. So how much do we owe after we make this payment? Well, we owed 30. We just reduced our debt by $441.14. So that's going to leave us a balance of $29,558.86. All right, now pause the video just a moment and see if you can come up with our second payment's interest amount. So again, a month goes by. February 28th, we're going to again do $566.14. How much of that would go to interest? Well, hopefully you paused and this is what you came up with. Well, remember, the carry value will change over time. The principal of the note is reduced with each payment. So we're going to take the $29,558.86, multiply that by the 5%, and then again, it is just 1 out of 12 months. And that's going to give us $123.16. Now, how much is going to decrease our balance? Well, we take the $566.14, and you're going to subtract the $123.16, so that means $442.98 will go to reduce our debt. We owed $29,558.86, so that means we have left $29,115.88. All right, pause again, see if you can come up with the last one. Hopefully you pause. So what you should have done is take the $29,115.88, multiply that by 5%, then multiply that by 1/12, or 1 out of 12 months. And when you do that, you end up with $121.32. And again, we are rounding to the penny here. So take $566.14 minus the $121.32. You come up with a decrease of $444.82. Now, what does that leave us with in our balance? We'll take that $29,115.88, subtract out the $444.82, and you end up with $28,671, so $28,671.06. And then we would continue on if we needed to for the rest, all the way down for 5 years or 60 payments. Now, we're not going to do 60 payments worth. That would be crazy. That would take a lot of time. But hopefully that helped you see how would we complete an amortization chart for a loan. Notice it's very much like the annual in the first. The only difference is we're only accruing 1 month of interest before each payment. Okay. Now, how would we journalize this? Well, at the inception, January 1st, we would go in and we would debit our truck account or whatever asset our company used. Delivery truck might be good because that's what we purchased. So we got a delivery truck asset there on our books now. And we're going to hit that for the purchase price, the $30,000. Then we're going to hit our notes payable. Now notice in this case, we bought an asset and signed a note. We did not borrow cash. Whereas in the last example we borrowed cash. So a little bit different in that respect. All right, now, just like before, our first payment, what would we do? Well, January 31st is our first payment. We're going to hit our interest expense for the amount that we calculated, the $125. Remember, we just basically journalized these three columns every single period. So it would be $125. Then we're going to reduce our notes. So we're going to hit our notes payable. We're going to hit it for $441.14. And then we're going to close out by paying that cash payment of $566.14. There we go. Okay, now we would do that exact same entry. Again, the only difference is going to be the split between how much goes to notes payable and how much goes to interest. So at the end of every period when we record this entry, that would be how we would record it. We would just make sure to update the interest expense and the note payable. I don't know why I put payables in there. All right. So hopefully that clarifies how to record the entries for a monthly payment. I hope you have a wonderful day.